Hi everybody, it's Monday, November 3rd, 2025. We begin our episode with today's headline: Caution, credit spreads are widening. The Federal Reserve Bank of St. Louis website has a high yield, in other words, junk bond credit spread that updates daily for the previous day in the morning. And we can see that on Friday, we were starting to widen a bit. And then if you want to get a more live version or way of seeing this, all you have to do is take the biggest, most liquid junk bond fund, HYG, divided by SHI, the government bond index with the same duration, and you get to see where are credit spreads today. And they dropped today pretty significantly. If this turns into a waterfall event, if credit spreads continue to widen further and further, it's sort of like taking the legs out of the stock market. So be careful here, is what the credit market is saying, loudly and clearly. Bitcoin's weakness is another signal that stocks may not have another leg higher, but we'll get to the rest of the charts in a moment. Before their community topics, thank you, everybody, for sharing your macro signals. I asked you guys to comment in the section to share a macro signal that you feel like nobody else is talking about. It was really cool seeing what macro signals you guys are paying attention to. Second community topic, I don't think I talked about it on the show, but it was in the comment section, Stock FI. I briefly put a comment on there that I said I bought 3% of my portfolio in this. Anyhow, the comment's gone and I sold all this stock because I jumped in too early. A commenter actually helped me get aware to this, noting, hey, is this really a Ben Graham situation? And I was on the side like it had dropped so far and I was just looking at current PE ratio, but then I got to my senses and thought, what would Graham think about this situation? And I'm no longer in this stock. If it drops to a price of 50 or lower, that's when it starts to become interesting. That's when it's 30% below what's considered a leading value or leading stock fair valuation with a discount of 30%. Third community topic today, I did another video earlier today, so see my special edition. It's a separate video, and it compares the valuation of Cisco in the 90s to 2000 to NVIDIA today, a bull and bear case. I recommend checking it out and commenting what you think about it. Coming up, economic data is still in limbo. We have no PCE data, no initial continued jobless claims for multiple Thursdays, no employment unemployment report. These are huge reports, hugely important, not just for all market participants, but for the Fed themselves, recently discussing how they're operating in a fog. There was one news update today. Apparently, SNAP payments, in other words, food stamps, are going to continue, but apparently only at the half of the rate that they were at. This is obviously a move to pressure Congress and the Senate to, agree on the spending thing here so we can open back up. So in addition to being nervous about, being able to fly anywhere, many people's federal workers' paychecks being paused, and economic data in limbo. Now we have snapped in half. It seems we may get a resolution sooner than later in my crystal ball. And don't forget about those tariff updates that we will keep getting. Also, this Thursday, Nissan will release its earnings. TradingView has Nissan stock, by the way, saying that they already did earnings. It was guidance that they released, I believe. I don't think they actually did release their earnings. I believe that is scheduled for this coming Thursday. Correct me in the comments below if you know better. Anyhow, thank you for watching, liking, subscribing, commenting, and supporting Robschild. No changes to the ball ratings. And see my website, link in the description, to read through my daily reminders, current macro views, portfolio explained, and stock research center. On to charts. SPX, S&P 500. Your regular person might not get scared by this chart. We are hovering near all-time highs. Maybe some people are interpreting this maybe even as a bull flag. In addition to credit spreads widening and Bitcoin not showing very much strength, I want to add that these are all red candles here for 5 days. This can frequently occur when certain market participants, when the liquidity is low overnight, they push the price up higher so that it gets more people to want to buy. And the big money, the institutions, unloading as much as they can into as much strength as they can. That's what a bunch of red candles kind of suggests. Also, intraday, it seems we are getting the lunch crowd to float the market back up. And then when the pros come in, especially in the morning hours and the power hour, 3 to 4 o'clock, that's when the dumps are happening. The VIX fear gauge popped up higher than we've had intraday since October 23rd, but still not even to 20 yet, which marks sort of the floor for panic mode. And similar thing going on in the VVIX, volatility of volatility, poking its head into rising uncertainty area, but then closing in a normal territory. Right now, the options markets are expecting to be able to continue this flotation, I'll call it, in the stock market. The 10-year Treasury note yield rose by 3 basis points today, higher but losing momentum to the upside. Bitcoin as a record is down 3.6%. 106,500 is 15% down from the all-time peak. The dollar also rose today, also losing momentum to the upside, like in the 10-year. I've been expecting crude oil to be falling. It's sort of stalling here still. Again, this rise was because of sanctions on Russia. Without a oil shock or some kind of like miraculous economic data coming out, oil is destined to go lower from here. Total 2, all cryptocurrency minus Bitcoin had a good drop today of 7%, including Fartcoin all the way down to, I think, 20 cents today. CNN Fear and Greed Index is, we were solidly in fear. Now we're right between fear and neutral. I don't think this can't last if credit spreads continue to blow out. We are headed back down into fear and in extreme fear if HYG continues to fall. Last chart of the day, 10-year minus 2-year, just because it gives us a true sense as to whether markets expect or need rates to go up or down or to pause. So first of all, the spread is, it's not very high, historically speaking, being at about 0.5%. And we're in a cutting cycle. We're expecting the Fed to cut and cut and cut. So right now, at the very tail end of this chart, I still see lower highs and lower lows, and that suggests not only do we need the expected cuts, but maybe the expected cuts are not enough. We're far away from, going back into an inverted state, but something to monitor closely nonetheless. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching. Don't forget to watch my special edition, and see you next time. Robschild.